If I told you that the United States has a financial trick so powerful that it allows the government to borrow unlimited money from itself without ever admitting it's printing a single extra dollar, would you believe it? Because this is the true, hidden, almost unbelievable story of how the U.S. government buys its own debt, how bonds quietly control global stability, and how a 100-year-old financial machine still fuels America's wars, rescues, crises, and economic dominance. To understand this, you have to travel back to a moment in history when America stood completely broke. The Great Depression, banks failing, unemployment exploding, and the government desperately searching for a way to push money into the economy without destroying trust in the dollar. That's when the Treasury and the Federal Reserve struck a historic agreement. We will not print money directly. We will issue bonds, and you, the Federal Reserve, will buy them if the economy ever needs saving. What they created was the foundation of the modern bond market. The Treasury sells IOUs. The Federal Reserve buys those IOUs using digital money it creates from nothing. And because it happens through markets, it doesn't look like printing. It looks like monetary policy. This trick became America's most powerful economic engine. During World War II, posters told citizens, buy war bonds. Celebrities begged people to support the war. Families gave their savings. But behind that patriotic messaging, the Federal Reserve was quietly scooping up billions in bonds at fixed interest rates so low that the government could afford the war. America's victory was financed not just by tanks and factories, but by the Fed buying the government's debt and stabilizing interest rates so they didn't explode. After the war, the U.S. had issued the biggest debt in world history, but something strange happened. The economy boomed. Bond yields stayed low, inflation fell, and the government realized something profound. As long as the world trusted U.S. bonds, America could borrow forever. This set the stage for the next financial revolution. In the 1970s, inflation raged, oil prices skyrocketed, confidence collapsed. Paul Volcker, the Fed chairman, took dramatic action, raising interest rates above 20% to kill inflation. Mortgages doubled, businesses collapsed, cities went bankrupt. But in the background, the same bond-buying trick was used to stabilize the system when needed. And after inflation died, something unexpected happened. Foreign countries, especially Japan and later China, started buying U.S. bonds in massive quantities. Why? Because America's debt, backed by the world's reserve currency, was the safest investment on Earth. U.S. bonds funded Asian export economies, American consumption, and global trade. The world had become addicted to U.S. debt, and the U.S. had become addicted to the world's willingness to hold it. But the real test came in 2008. Banks collapsed. Credit froze. The stock market lost half its value. The Treasury needed trillions, fast. And that's when the Federal Reserve unleashed a new weapon with an old foundation: quantitative easing, a fancy name for aggressively buying government bonds using newly created digital money. In simple terms, the U.S. issued debt, and the Fed bought it. The world watched in confusion as the Fed purchased more than $4 trillion of bonds, becoming one of the biggest lenders to the U.S. government. Interest rates dropped to zero, banks were saved, markets stabilized, and the U.S. economy slowly came back to life. Critics screamed, "This is money printing." Supporters argued, "This is the only reason the financial system didn't collapse." The truth is both. The bond trick had reached a scale nobody imagined possible. But the story didn't end there. The next chapter was even bigger. In 2020, COVID shut down the planet. Businesses closed overnight. Unemployment hit record levels. The government needed money, fast, to prevent total disaster. And once again, the U.S. issued bonds. Trillions of them. But who was going to buy that much debt in such a short time? The answer: the Federal Reserve. The Fed bought more than $120 billion of bonds every single month, injecting enormous liquidity into the system. The government used that money for stimulus checks, unemployment boosts, business loans, vaccine distribution, hospital funding, food programs, and emergency operations. In a very real sense, America saved itself with its own debt. But this time, the bond trick had global consequences. Interest rates collapsed to the lowest levels in history. Stocks soared. Cryptocurrencies exploded. Home prices skyrocketed. Inflation surged. And suddenly, the entire world realized something. The Federal Reserve's bond-buying ability isn't just a tool, it's a global force. The U.S. government and the Federal Reserve had become partners in a financial system unlike any other on Earth. Treasury issues debt. The Fed buys it when markets panic. Wall Street trades it. Banks use it as collateral. Foreign nations store it as reserves. Pension funds depend on it. And regular people don't even know it's happening. But let's go even deeper, because the trick gets more interesting. When the Fed buys a bond, it doesn't pay with physical money. It simply credits banks electronically. That money becomes deposits. Those deposits become loans. Those loans become spending. And that spending becomes economic growth. Meanwhile, the government owes interest on the bonds. But here's the twist. The Federal Reserve returns most of the interest it earns back to the Treasury. Yes, the government pays interest to itself. And the money comes right back. This circular flow is one of the strangest yet most powerful mechanisms in modern finance. But it also creates long-term dangers. Every time the government issues more debt, the total interest it must pay grows. If interest rates rise too fast, the debt becomes harder to manage. If foreign countries buy fewer bonds, the Fed has to buy more. And if investors ever lose confidence in the US dollar, the entire global financial system could shake. But for now, none of that has happened. Why? Because the US has three unmatched advantages: its currency, its central bank, and global trust. As long as the world uses the dollar, America can issue unlimited bonds. As long as the Federal Reserve can buy those bonds, the U.S. can finance crises, wars, inventions, and recoveries. And as long as the global system relies on U.S. bonds for stability, the demand will never disappear. This is why America remains the world's financial superpower. Not because of gold, not because of oil, not even because of military strength, but because of the hidden magic of the U.S. bond market, an invisible engine that has been driving the world economy for nearly a century. Today, U.S. bonds sit at the center of everything: government budgets, global trade, bank stability, pension security, mortgage rates, stock valuations, and currency exchange. And whenever disaster hits, the same trick returns. Issue debt. Let the Fed buy it. Stabilize the market. Rebuild confidence. Restart the economy. Again and again. Every recession. Every crisis. Every panic. And the average person has no idea. That is the power of this system. That is the silence behind the chaos. That is the financial magic trick that keeps the world afloat. This is the true, untold, unbelievable story of how the United States buys its own debt, finances its own recoveries, rescues its own economy, and maintains global dominance, one bond at a time.